You have probably heard the expression, "It pays dividends." We use it all the time. You work hard at something today and it pays dividends later. You invest in a relationship and it pays dividends down the road. It means an effort you make now produces rewards in the future. But in the world of stocks and investing, sometimes that expression is completely literal. Companies actually send you money, regular cash payments, just for owning shares in them. And the questions most people have when they first hear this are the same ones. Is this really free money? What is the catch? How much can you actually make? And should you be investing in dividend-paying stocks in the first place? In this video, I am going to answer every single one of those questions, clearly, honestly, and without any of the jargon. By the end of this video, you will understand exactly what dividends are, how they work, and how to think about them as part of your strategy. Let us start from the beginning. A dividend is a regular payment of a portion of a company's profits to its shareholders. Think of it this way. When you buy shares of stock in a company, you become a partial owner of that business. A small partial owner, but an owner. And when that business earns a profit, it has to decide what to do with the money. Option 1. Reinvest the profits back into the business. Hire more people, build new products, expand into new markets, grow the company. Option 2. Return some of those profits to the people who own the company, the shareholders, in the form of dividends. Most companies that pay dividends are established, mature businesses where growth has slowed to a more predictable pace. They have more cash coming in than they can efficiently reinvest into high-return growth opportunities. So they return the excess to shareholders. Think of companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's. Businesses that have been around for decades generate consistent cash flows year after year and distribute a portion of those cash flows to their investors on a regular schedule. Newer, faster-growing companies tend to keep all their profits inside the business because they have better uses for the capital, growth that compounds faster than distributing it to shareholders. That is why companies like Amazon and Google historically did not pay dividends. Neither approach is automatically better. They reflect where the company is in its life cycle and how efficiently it can deploy capital. Let us make this concrete with a simple example. Say you own 10 shares of a company and they announce a $1 dividend per share for the quarter. You receive a $10 payment. If the company does this every quarter for the full year, you collect $40 in total dividend income for the year just for owning those 10 shares. Now, a few important dates you need to understand. The declaration date is when the company announces it will pay a dividend. The ex-dividend date is the cutoff. If you own the stock before this date, you receive the dividend. If you buy it on or after this date, you do not. This is why you sometimes see stock prices tick up before the ex-dividend date, investors rushing to get in before the cutoff, and then pull back slightly on the ex-dividend date itself. The record date is when the company confirms which shareholders are on the books to receive the payment. The payment date is when the cash actually hits your account. Most companies pay dividends quarterly, 4 times per year. Some pay monthly, which is especially common among REITs and certain income-focused funds. Some pay annually. The dividend yield is how most investors measure income. If a stock is trading at $100 and pays $4 in annual dividends, the yield is 4%. Most companies in the S&P 500 that pay dividends yield somewhere between 1 and 4% annually. Anything above 5 or 6% warrants extra scrutiny. Quick question before we go further. Are you completely new to dividends and just learning how they work? Or are you already a dividend investor looking to go deeper? Drop your answer below. Beginner or investor? I reply to every single comment and I want to know exactly where you are starting from. Here is one of the most powerful concepts in dividend investing that most beginners completely overlook. You do not have to take your dividends as cash. Most brokerages offer what is called a dividend reinvestment program, or DRIP. Instead of the dividend payment hitting your account as cash, it automatically purchases additional shares of the same stock, even fractional shares. Why does this matter? Because of compounding. When you reinvest dividends, you are buying more shares. Those additional shares generate their own dividends. Over long periods of time, this compounding effect can be transformative. A portfolio with dividends reinvested over 20 years looks dramatically different. Some funds even offer DRIP programs at a slight discount to market price. It is one of the small structural advantages most people never notice. Not all dividends are taxed the same way. This matters for your actual after-tax return. Qualified dividends receive more favorable tax treatment. To qualify, the dividend must come from a U.S. company or qualified foreign corporation, and you must have held the stock for more than 60 days before the ex-dividend date. Qualified dividends are taxed at long-term capital gains rates, which are lower than ordinary income tax rates for most investors. Ordinary dividends do not meet those holding requirements and are taxed at your regular income tax rate. Be aware of your holding period. A tax-advantaged account like an IRA or 401k shelters the income from immediate taxation entirely. Dividends are not just something individual companies pay. You can collect dividend income from several different types of investments. ETFs and index funds collect dividends from all the companies they hold and pass them on to you. Even broad market funds generate income. REITs are companies that own income-producing real estate. By law, they must distribute 90% of their taxable income to shareholders. When you buy a bond, you are lending money to a company or government. In exchange, they pay you a fixed rate of interest on a regular schedule, which is sometimes loosely called a dividend. Unlike stock dividends, this interest payment is a legal obligation, not a discretionary decision. Now the part most dividend content skips: the honest trade-offs. The case for dividends is real. They provide predictable, plannable income. For investors close to retirement, that cash flow predictability has enormous practical value. You can plan your life around it. A growing dividend stream also acts as a built-in inflation hedge. If the dividend grows, your income keeps pace with or exceeds inflation. And the psychological effect is real. It is much easier to avoid making emotionally driven selling decisions during a market downturn. A dividend is not free money. When a company pays a dividend, the stock price adjusts down by approximately the dividend amount on the ex-dividend date. The wealth is transferred from the company's assets to your account. High yield does not mean safe. When you see a stock yielding 15 or 20%, the most important question is, what is broken here? High yields are frequently a signal of a coming cut. A company borrowing money to pay a dividend is not in a sustainable situation. And dividend-focused portfolios can lag pure growth portfolios during extended bull markets driven by technology and high-growth sectors. If the last 10 years of AI and mega-cap tech growth have taught dividend investors anything, it is that opportunity cost is real and needs to be part of the calculation. Here is the framework I would use. Do not invest in something just because it pays a dividend. It is one signal, not the whole story. Look at the whole picture. Is the company profitable? Is the payout covered by real cash flow, not borrowing? Is the balance sheet healthy? If you are in your 20s or 30s and decades from needing the income, reinvesting every dividend you collect will compound dramatically over time. If you are approaching retirement and need predictable cash flow, dividend-paying investments become genuinely more valuable. Dividends will not make you rich quickly, but invested wisely, they can become one of the most reliable engines of wealth building. Where are you in your own dividend investing journey right now? Just starting to learn what dividends are, actively building a dividend portfolio, or somewhere in between? Drop your answer in the comments below. I reply to every single one. Hit subscribe for more content like this every week. Now go build something real.